Do you want to be a successful investor and do you struggle with decision making when it comes to investing? Then you need to be aware of the common mistakes that new and even experienced investors keep making. For example, do you have a habit of fixating on losses more than you pay attention to profits? That's called loss aversion, and we'll discuss how to shift your mindset towards positivity. So let's get started with the first mistake. Do you ever feel like you're drowning in a sea of information when it comes to investing? It's easy to get overwhelmed with all the news and social media posts and all the financial advice that's out there. But the truth is, not all information is created equal. In fact, one of the biggest mistakes we can make as an investor is falling prey to information bias. This is when we believe that having more information is always better, even when it's irrelevant or misleading. Let me give you an example. Imagine you're considering investing in a company that produces solar panels. You come across an article that talks about how great solar energy is for the environment, but it doesn't actually provide any useful information about the company's financials or how they manage the company. Sure, it's good to know that solar energy is important, but it doesn't really help you make an informed decision about specific investment opportunities. It's easy to get caught up in trying to understand every piece of information, but this can lead to analysis paralysis, which is the feeling of being unable to make a decision due to overthinking and over-researching a problem. So how do we avoid falling into the trap of information bias? First, we need to filter out the noise and focus on the information that's most relevant to our investment strategy. This means knowing what we need to know and what we don't. Stick to your investment goals and strategy and don't let irrelevant information cloud your judgment. For example, if you plan to invest in broad market ETFs, which includes hundreds of different companies, you don't really need to pay attention to news or information about specific companies. Second, be a skeptic when it comes to information you receive. Don't take everything at face value. Do your own research to ensure that the information is accurate and reliable. So remember, when it comes to investing, more isn't always better. By focusing on what matters and ignoring what doesn't, you can avoid the mistake of information bias and make more informed investment decisions. Now, let's talk about another very common mistake that new investors make. Have you ever heard of the saying, cut your losses and let your profits run? Well, it turns out that our brains are wired to do the opposite. We're more afraid of losing money than we are excited about making money. This is what's called loss aversion, and it can lead to some pretty bad investment decisions. One study that confirms this is the prospect theory study. The study showed that individuals tend to feel the pain of a loss twice as much as the pleasure of a gain. In other words, people are more likely to take greater risk to avoid losses than to achieve gains. The study shows that people are loss averse even when they are in situations that require them to make rational decisions. For example, when given a choice between a guaranteed $1,000 or a 50% chance of getting $2,000, most people choose the guaranteed $1,000. On the other hand, when given a choice between a sure loss of $1,000 or a 50% chance of losing $2,000, most people choose to gamble on the 50%. The problem with loss aversion is that it can cause us to avoid taking risks, which can limit our potential to gains. To overcome this bias, it's important to focus on the potential gains of an investment and not just the potential losses. It's also crucial to consider the odds of success and failure before making any investment decisions. For instance, let's say you're considering investing in a new company that's developing a revolutionary product. You've done your research and the company seems promising. However, there's still a chance that the product won't sell as well as expected, and you could lose some or all of your investment. Instead of focusing solely on the potential loss, consider the potential gains if the product is successful. You may be more willing to take a calculated risk and invest in the company. So remember, by focusing on the potential gains and carefully evaluating the odds of success and failure, you can avoid the trap of loss aversion and make more informed investment decisions. Have you ever found yourself continuing to invest time, money, or effort into something that you know deep down is not working out? That's because of something called the sunk cost fallacy. This cognitive bias occurs when we focus too much on the resources we've already invested and ignore the potential costs and benefits of our future actions. For example, let's say you invest a lot of money in a stock, but it's not performing well. Even if the stock's value continues to decrease or you learn new negative information about the company, you may be reluctant to sell it because you've already invested a lot of money. One study found that sunk cost fallacy can be a powerful motivator in decision making. Participants were given a hypothetical scenario where they had invested money in a project that was not going well. The results showed that the more money participants had invested into the project, the more likely they were to continue investing in it, even if it was clear that the project wasn't going to succeed. To avoid the sunk cost fallacy, it's important to set clear investment goals and predetermined exit points before you make any investment decision. By doing this, you can avoid making decisions based solely on past investments and focus on future potential of the investment. The next mistake a lot of investors make is due to something called the bandwagon effect or herd mentality. Imagine you're in a movie theater and everyone around you is laughing at a particular scene in the movie. Even if you don't find it funny, you might feel the urge to laugh along with the crowd. This is the bandwagon effect in action. You're following the actions of a larger group. Similarly, in investing, the bandwagon effect can cause people to follow the crowd and make investment decisions based on what others are doing, rather than analyzing the investment opportunity themselves. This can be a huge problem because it can cause bubbles and crashes in the market. Just think about the dot-com bubbles in the late 90s. People were investing in tech stocks like crazy, even if the companies didn't have a solid business plan. And when the bubble burst, investors lost a ton of money. So what can you do to avoid falling victim to the bandwagon effect? First, you need to think independently and do your own research. Don't just follow the herd. Second, try to avoid getting caught up in the hype and FOMO. Just because everyone else is investing in something doesn't mean you should too. Remember, blindly following others can lead to poor investment decisions and significant losses. Have you ever been in a situation where you were presented with a complicated legal document or contract, but you didn't fully understand the terms and conditions? Maybe you just skimmed through it and signed it anyway because you trusted the other party or didn't want to appear uninformed. This is an example of the oversimplification bias. You oversimplified the legal language and its implications and took action without fully understanding the risks involved. Similarly, in investing, the oversimplification bias can lead investors to oversimplify complex investment opportunities without fully understanding the underlying fundamentals of the investment and make uninformed decisions. This can result in investing in assets that are overvalued or not aligned with your own investment goals. To avoid the oversimplification bias, it's important to do your own research and seek advice from qualified professionals. Don't rely solely on simplified information or the opinions of others. If you're unsure about a particular investment opportunity, take the time to learn about it and understand the risk involved before investing your money. Remember, investing involves complex financial concepts and jargon, but oversimplifying them can lead to misguided decisions. So take the time to educate yourself, seek professional advice, and invest in areas that you understand well. The next mistake is something that we do in almost all aspects of our lives, and it's driven by the confirmation bias. It's human nature to seek out information that confirms what we already believe to be true, and to discount information that contradicts our beliefs. This can be especially dangerous when it comes to investing, as it can lead us to make poor decisions based on incomplete or biased information. For example, let's say you believe that a certain company's stock is going to perform well in the future. You might be tempted to only look for news articles or analyst reports that support your belief. But by doing so, you could be missing out on important information that contradicts your opinion. One way to overcome confirmation bias is to actively seek out information that challenges your assumptions. This means looking for evidence that contradicts your existing beliefs and seeking feedback from others who have different perspectives and opinions than yours, and be willing to change your opinion based on new information. Ultimately, the key to overcoming confirmation bias is to cultivate a mindset of curiosity and skepticism. Always be willing to question your assumptions, seek out new information, and challenge your own thinking. By doing so, you can make more informed and objective investment decisions. Have you ever found yourself looking back at a situation and feeling like you knew all along how it would turn out? That's hindsight bias. It's like watching a sports game and saying, I knew they were going to win after the game is over, even though you never said it during the game itself. As an investor, hindsight bias can lead to overconfidence and poor decision making. It's important to recognize that past events are not always predictable and that we can learn from our mistakes instead of simply blaming them on bad luck. One way to reduce hindsight bias is to keep detailed records of your investment decisions and the reasoning behind them. By writing down your thought process and estimated returns in advance, you can avoid rewriting your investment history with the benefit of hindsight. The last mistake on our list is caused by an often overlooked bias that can negatively impact our investment decisions, which is called the restraint bias. It's the tendency to overestimate our ability to control our impulses and desires, especially when there's a chance of earning significant returns on investments. One way to overcome restraint bias is to develop a better understanding of your own impulse control. This can be done by setting clear investment goals and limiting your exposure to risky investments. Another way is to identify triggers that often cause you to behave impulsively, such as excitement or pressure to make a quick decision. By recognizing these triggers, you can better prepare yourself to make rational investment decisions. It's important to note that restraint bias is not the same as risk aversion. Restraint bias is about impulsivity, while risk aversion is about a reluctance to take on risk. While restraint bias can lead to taking unnecessary risks, risk aversion can lead to missing out on potential profitable investment opportunities. Finding the right balance between restraint and risk taking is key to making sound investment decisions. So, it's important to be aware of everything that can affect our investment decisions. By understanding and acknowledging our mistakes, we can take steps to overcome them and make more informed decisions in the future. Whether it's a tendency to follow the crowd, hold on to losing investments, or oversimplify complex situations, there are strategies we can use to fight this. By taking the time to do our own research, set clear investment goals, and challenge our assumptions, we can increase our chances of success and achieve our financial goals. Thank you so much for watching. I hope this helped you out, and if you enjoyed this video, please like and subscribe. That really helps me out and lets me know to make more of these types of videos in the future. See you next time.